We're going to talk about commodity and export finance, and decided specifically to focus on the agricultural business, on food export finance, as is fitting for the last session before lunch. To help me do that, we have three gentlemen very much involved in the area of agricultural finance. Alejandro Fernandez from Bunge Latin America, Emerson Pieri, the managing partner of Barings Investments, and James Varnadoe, founding partner of SGD Fund. Thank you all for joining us. Now we're moving from the general topics of the first couple of presentations this morning to the more specific, and one of the big things we heard a lot about inevitably is trade wars. Alejandro, how's it been for you with the trade wars this year?
Thank you, Richard, for the introduction. Trade wars. Well, with what has happened with Trump so far this year, we've all seen the impact of this China tariffs affecting the commodities markets, particularly recently with the imposition of a 10% tax on Chinese goods and the reaction of the Chinese imposing a 25% tax on soybeans has significantly materially affected the trade flows of soft commodities in general, and particularly soybeans going into China. We've seen a tremendous amount of our flows originating from Brazil instead of US going into China. The impact has been material. We've seen from 65% of the Brazilian exports going to China. Now, this past month, we had 89% of the exports of soybeans going into the Chinese market instead of other markets. So this change in the origination of the grain has materially impacted our trade flows in the past few months. Now, the crop in the United States will begin in harvesting in October. And that's more or less when the final goods of the crop from southern cones can get exported into China. So we'll wait and see how the markets react at that point in time in the prices.
Emerson, James, good for business?
Yes, it is. Actually, we see a rise of prices in around 5 to 7% in the soybean in South America. Brazilian exporters are really happy with this trade war, and including Paraguay, who is a big exporter now in terms of soybean. And for us, what is important is this trade war between China and US will benefit South America in one way, in terms of pricing, in our point of view. But if the duration of this trade war is long, can create some damage, principally for the exporters who wants to finance the crop.
Mm-hmm. And James, share the opinion?
So the feedback on the Trump administration and the trade war is it's a goal, it's for a limited period of time. It's to accomplish other things that we have an issue with China, mainly intellectual property. And how that cycles back to soybeans is convoluted at best. So what the US exporters have to worry about is that these new sources of the soybeans don't permanently displace the American sources of soybeans. And because if it lasts for any period of time, it's going to significantly impact the US farmers. That is a major concern. The farmers are trying to support the administration, but they're nervous, and exactly what you said, if this starts to drag on, the administration may lose support and they may try to unwind some of these trade tariffs that they're imposing. Obviously, it goes to all kinds of goods and services, which the American consumer is going to start feeling the impact. Probably you'll start hearing more about this at Christmas time when all these television sets and things that we import from China go up significantly. So that remains to be seen. But that's what's happening.
What do you think is going to happen? Do you think that we're going to have pushback on this? It seems like it's going the other way at the moment, that actually tariffs are increasing.
James just touched on an important topic, and I think that what we've seen so far is very different where we think or what could happen in the near future. So far, what has happened? Well, we've seen changes of our exports originating from Brazil from 65% to 89%. That's a material change if you consider the fact that that's the full crop of what we are exporting as Bunge from the Brazilian market. Now, we look at what's happening to the United States, and yes, this is impacting the farmers here because their crop is not out yet. Their crop is going to come out in October, but the futures market is already trading that crop, right? So we've already seen the impact of prices hitting the market on soft commodities, particularly soybeans. But this has also been hitting corn. It has also been hitting wheat and other soft commodities in the market where we've seen prices decline. What will happen in October when the crop comes in play? That's the question. Because if we still have U.S. crop not going to China, where's it going to go? Is it going to go to Europe? Is it going to go to the Middle East? Is it going to go to the Indian market where it doesn't have that problem, or Indonesia where there's also a lot of population? So where that product goes to, Richard, that's the key question. Are these new markets going to pay the commodity at the same level that the Chinese market would have paid for it? And what happens to the Chinese market? Is it really that they're going to have to find other sources of this product forever, as James was pointing out? Or is it just some shock that's happening right now because of these Trump taxes? So that's a really valid question. And where we're going to be going, we don't know. But one thing I can tell you is once you've opened up Pandora box and you've opened the possibility of other people looking into where else can I source this product other than the United States, yes, it will have a long-term impact. And it already has, because if you look at what has been the trend of the crops that are being imported by China, you can see that the soybeans more and more are coming from the southern cone. And I mean Paraguay, I mean Brazil, I mean Argentina, not just the United States.
Emerson, are you seeing any more longer term changes in the businesses? Reorienting towards different trade flow?
Yes, I think new markets are being explored by the Chinese now. If you see in Latin America, they're starting to invest in Bolivia to produce soybean. And in Paraguay, they are majority, almost 60% of the soybean produced in China, in Paraguay, are financed by Chinese firms. I think U.S. is losing a big opportunity here, in my point of view. Okay, no Barings, but compliance will kill me. But I think what's going on in the future, if this keep going, I think U.S. will have a lot of soybean in their stock because prices will increase, China will not buy, and Trump will die with the soybean that he's not selling. This is my point of view.
Drown them.
Exactly.
I would like to add a point there is also in the long run, commodity trading companies like us, we're also very concerned about what happens 50 years from now. Are our commodities, particularly soft commodities, growing sustainably? And I don't think they are. I was looking at some recent reports by the FAO about production of our food stocks. And I'm not just talking about corn, soybean meal, which are the grains. I'm talking about poultry, fish, cattle that all feed on these grains. The reality is by 2050, we won't have enough land in production to feed all the people in the world. So no matter what happens here in the short run with all these trade wars, we will reach a point where the land is finite and our productions are also limited. So prices will eventually be affected, and we will have to find out different sources to feed the world, or ways or mechanisms to reach maybe buildings that will hydroponics or something technology. Who knows? We don't know what 50 years from now we will be doing, But the reality is the costs of what we do today will be very different.
That's a whole new topic, and it's an interesting one that we didn't touch on before, but green finance, green investments coming into this, and green in the sense of dedicated funds.
Well, Emerson touched an important topic. China is already financing a lot of the crops in the world because they're the biggest importer of all these grains. Unlike the United States, Brazil, and Argentina, which are net exporters of grain, the rest of the world is not. They're net importers. Even Latin American countries like Mexico, Colombia, we've seen the statistics, their numbers. They are net importers of these products. When you look at Indonesia, they don't have land. They import everything. You look at India, even India imports a lot. They produce, but they have to import the difference because they have too many people. So Europe, the same. So what ends up happening here is you have an imbalance of a situation where the trade flows are really going to be going into. And that's the question. That's where we really need to focus, is where the originations are going to go and where they're going to come from, and who's going to be doing the financing. The green, the latest frontiers, everybody talking about Africa. I mean, there's a lot of land left in Africa that hasn't been used, but is it going to be the Chinese investing and buying these lands and putting it into use? It could be. It could very well be that's how they will end up investing in the near future to solve the situation of all these trade wars.
So we're going from the next season to 50 years in the future. So are you seeing in any of your clients any fundamental changes and shifts to think about exactly, Alejandro's kind of
What is
flows?
happening now, I think, well, at least in my area, I am at Mercosur, Brazil, Argentina, Paraguay, Uruguay. They are shifting to non-GMO, okay? And we are glad to finance that. This is important. And the Chinese just realized that non-GMO products are much more valuable in their market than the GMO, okay? Even you guys from Bunge or ADM or whatever, they are seeing an opportunity in this market. Mm-hmm. When you talk about not only Chinese, but the Europeans buying soybean in South America, they look us like, okay, you produce the food and we eat, just that, okay? In the terms of lending money to finance the production down there, this is another story. Okay, the risk, the country risk is still existing. Brazil, I am Brazilian, is a roller coaster. Okay, we never know what is happening tomorrow. History can be changed in Brazil, and but we produce a lot of soybean. Another countries, like you said, in Africa, okay, they have a lot of land, but who will die there? If a guy like me go to Africa, how will find the producer? How I will finance the producing? Or how I will administrate everything? There are several issues to be covered. And I think the Chinese have a little bit more, how can I say? They are much more open-minded to new markets than any other country in the world. Something like I was in Australia last year, and I was impressed. In the middle of desert, they are producing soybean. Okay, financed by a Taiwanese company. Man, we are talking about $75 million in exports of soybean in a region in the central Australia. This is amazing, with Taiwanese technology. I think they are looking in 50 years from now how to produce more food, investing in different countries. And U.S. is losing an opportunity, I repeat, to keep Chinese in their accountant.
To add to that, in a macro sense, before President Trump came into office, we have to remember the Chinese were in Latin America in a big way.
Yeah.
They are a consumer of commodities, and they look to Latin America to supply those commodities. So they've been all over Latin America anyway. What this export war does, trade war does, is just give them economic reasons to be down there. It's really just greasing the rails for them to continue what they were already doing before Trump came into office.
Let me talk on another topic which I think is probably relevant, and I want to know how relevant it is. US rate hikes. There's obviously in a very aggressive rate hike cycle. How clear is the transmission from Fed funds rates into the charges that you pay, that you charge your customers? Emerson?
No, go first.
You don't have to quote prices
I got the ball. Well,
in general
what I've seen in general terms, I have definitely seen this increase having a serious impact in our final consumer base. I mean, yeah, our average invoice is $1 million, right? But I mean, we're selling a little over $300 million a month just out of our office here in Miami. We're a $50 billion commodity trading company, so it's huge. And every little percentage rate increase, even 10 basis points, can have a material cost impact on everything. So yes, the cost gets transferred to the final buyers. That's the only thing we can do because the commodity prices themselves don't have margin enough, and we have to transfer that directly. So eventually it trickles down to them. And 10 basis points can be material in certain markets because it'll eventually transfer into inflation once you use that corn or soybean meal or wheat into whatever you're milling into or feeding poultry or fish, so on and so forth. So it has this little multiplicative effect over time. 6 months from now, the corn we're selling into Colombia will become, some supermarket product. And that eventually will be inflationary in pressure. So what we've seen so far is concerning, but I think so far it only has been 75 to 100 basis points in increases in the past year, right? The question is, we are coming back from the decline we saw in the last decade after the crisis. Once we start reaching back up to certain levels, the question will be, will our customers' balance sheets be able to hold the increase in financial costs without seriously deteriorating their net margins? And I think this is critical for all of us because we as a supplier will finance buyers, but all the financial institutions will also do the same. So the question is, how much of this can be transferred to the final buyer? How much has to be absorbed by the companies that are throughout the supply chain?
Because like so many sectors of the economy, we've got used to low rates for such a long time now.
It goes all the way from the farmer, even the fertilizing companies, all the way to the final poultry producer or just a bread milling operation in Mexico that produces Bimbo, bread. So you'll see it throughout the whole supply chain.
James, I want to get onto the credit aspects of this as well and the volatility. Before I do, though, Emerson, you ducked that question, you passed it.
Okay, what happened is you have a chain reaction. In 2016, we had a crisis in South America, a financing crisis, and the interest rate dropped around 75 bips, okay? Nowadays, we stabilize it. We are in the levels of 2015. As I said, we need to wait until October to see what's going on here in US, the crop here in US, to see if the prices are going up. If they are going up, even if the interest rate have an adjustment, we have some fat to burn. If not, well, I think a lot of people in South America will have problem, okay? Because the margins are really, 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 really tight, okay? When Chinese or Europeans buy soybean, man, they squeeze the producer to the end, okay? And in my point of view, if the US succeed in the crop year, we will remain the way it is. If not, at least 50 bips will be a reasonable bet.
50 bits of how much is going to be passed on?
Yes.
Right, okay. But it isn't that simple. There is the credit aspect. And
no, because this will impact not only the client balance sheet, okay, but the chain, okay? The poultry, the meat producer, and everything. You have inflation in this circle, And that's why so many countries in South America, they are really concerned about US. Because with all the situation in South America going on in Argentina, in Brazil, and now in Paraguay, 10 bips or 1 point in inflation rate represents a lot, and we are talking about food. Poor people cannot eat. If they do not eat, they do not vote. That's why.
In the first opening presentation, we saw a lot about different credit spreads for the sovereign risks in the area. And obviously that has to be reflected in the pricing too. And I guess two related questions. One is, how much is that pushing out the pricing for commercial banks, because they have more aggressive credit spreads, and pushing it onto private equity or venture capital, James, or how much does it also involve multilateral development banks in the financing? James,
we're a fund, so structured global trade, SGT, is exactly that. So we don't get our money from depositors, we get our money from investors. And those investors like high interest rates. We try to balance that with, modify with the type of facilities. So we can do factoring, but we'll try to put in another facility. It's a question of whether you want to try to keep a customer. Customers are hard to find, particularly ones that pay on time. So we don't want to lose the customer. If you're charging them 20% interest rates, they're always looking for the exit door. If you can set up an ABL, an asset-based lending facility, they'll work with you, they'll stay around longer, they tend to be a better customer. But if interest rates are rising on top of our higher cost of funds anyway, it becomes problematic. All of our contracts are rate adjustable, but that doesn't mean we'll turn around and increase the rate on the customer right away. It depends on where we priced him. We may have had some margin in there to keep him at the same rate for a little longer. But eventually that rate's going to go up. And once rates start going up, it's sort of a compounding thing. We haven't had as much rate increase as we would have if all the economists could figure out why wages haven't gone up. Now, the fact that wages haven't gone up, although it's a mystery to everyone in the economics field, that's kept a damper on rates increasing even more. But if those do cycle in, the rates are going to go up more. And what it does is, first of all, and we focus, not entirely, but the fund I'm involved with focuses in Latin America. There is a certain segment of the borrowers that fall out when the rates go out. They just can't afford it. It's either they take themselves out because we can't afford the rates, or we have to say we can't loan to you because, as Alejandro said, when you're looking at their balance sheet, it doesn't make sense in terms of what they're going to be paying in interest going forward. So unfortunately, that's the reality. A segment of these poor SMEs that can't get financing in the first place have even more pressure on them as rates go up. The answer to that is I don't know, but if I had to guess, I would say rates are going to go up more before they even out.
But is it a stratifying of the credit spectrum? You've got investors rather than depositors, you say, demanding equity returns. Does that mean you have to go down the credit curve to the double B, to the single B individuals within?
Just because you can charge a borrower 20% doesn't mean you will, because if you look at him and you're going to have a problem loan, you'd rather just say no thanks.
And I think James has a really good point on financing. Is we will, in the commodities, from what I've seen in soft commodities, we have a really wide range spectrum of the tier 1s, tier 2s, tier 3s, tier 4s, in different markets, different spectrums. What I mean by that, and I think Ileana showed us in the presentation earlier today, we looked at the two countries with the highest country risk spreads were Argentina and Ecuador. Surprisingly enough, Ecuador has a 600 basis point spread over Treasury. That's tremendous. You're talking, for 10-year Treasury, 3%, somewhere ranging there. 9% for 10-year loan on a corporate spread. That's tremendous. I mean, but yeah, that's where it is. So the opportunity for funds to go into certain markets where there's more country risk is tremendous. But at the same time, the risk mitigation mechanisms that have to be put in place for the underwriting team to feel comfortable, are more stringent. So that spectrum will depend heavily on where you want to go, which type or tier customers in that market you want to try to address. And we have customers in tier ones in certain markets like Chile, where their access to credit is really, really, there's a lot of liquidity in Chile, so they have access to credit that's really, really low rates. So we continue to see certain markets taking that advantage. Questions will be in the future is, are there going to be banks in Chile taking an opportunity of the arbitrage that they can do regionally? And maybe that's something that could be happening with the support of ECAs or some other entities that will help them mitigate the cross-border risks or corporate risks in other countries.
A lot of the clients, they've got that funding issue, also got FX issues, whether they're exporting to China or to America or elsewhere. What can you do to put in place when you sign contracts to protect yourself from their risk?
2014, I had an interesting case. I had a customer in Colombia. Right that year, we had, I don't know if you guys remember that shock when the prices of oils had this collapse. Colombia, their balance of exports depends on oil. There's a significant amount of it that the dollars in the country come from that. Most of my sales in that country are dollarized. So when I give credit to a customer in Colombia, or all the customers in Latin America, everything's dollarized. So going to your point about hedging, if I give 180-day credit for trade export financing on the short end to a customer in Colombia, and what I'm delivering to this customer could represent anywhere between 30 to 50% of the balance sheet, if they're not hedging this amount, you could have a serious problem when the devaluation of the currencies hit. And that's exactly what happened in 2004 in Colombia. You look at the rate, it went from 2,000 to 3,000 super fast. What does that mean for them? Well, they're not going to be able to monetize the local currency into dollars and pay us without having a serious problem. So what we're trying to do more and more is we're asking our customers to make sure that they materialize the forward hedges for currency risk. Same thing that we do constantly day to day when we're looking at forwards for the commodity pricing. What we do as a commodity trading group, we hedge the risk of the commodity. So we ask our customers to do the same thing to their balance sheets when they're taking risk in dollars. So that will allow us to mitigate part of the risk. It's not the only solution, and it's really hard for us as a commodity trading group to bring the whole solution. We're not a FX forwarding service provider. We need the banking institutions locally as well as internationally to bring about into the customer base both deliverable and non-deliverable forwards.
Emerson, James, do you work with banks to provide hedges? Do you insist on it? Are they enforceable in contractual terms?
We do not work with banks. We finance directly or using our own funds or third parties' funds. We are a multi-family office, which means that when we put banks together, they say, no, thanks. Because they don't want to use their own capital to finance agribusiness, okay? Excluding Brazil, that is a different case, okay? But all other countries in Latin America, it's very, very difficult to our commercial bank finance producers because they have so many risks. The currency, production, price drop, and weather, and whatever, okay? In our case, we can do financing because we have a structure done to soft commodities, okay? We take the risk of the client. And there are two conditions for us to lend money. First, The guy must be an exporter, okay, because we are charging them in dollars, and we want the exporters to guarantee the payment, okay? And the second one, the ticket is minimum 1.5 million. If they cover these conditions, we will analyze the guy's balance sheet, okay? In South America, you can use a lot of collaterals, okay? Like the land, I don't know, promissory notes, depending on the risk, but we don't do that. If the guy wants to finance or have another instruments to finance the crop, we have partners like Bradesco in Brazil, Sudamérica in Paraguay. We say, go to this bank, show all your collaterals, your guarantees. They issue to Barings LC, and we finance you. Okay? But we don't take the final risk. Never.
James, how do you think about the credit of your clients and protecting yourself?
Well, all of our contracts are in dollars, but that doesn't necessarily mitigate the risk is if they get caught at the time of payment and they don't have the money to pay you, or they don't have. We've got stuck one time in Jamaica, I think it was, and they got shortchanged on dollars, and they just couldn't pay us. So we had to wait for to get approved to get more dollars into the system. So yeah, you try to do things like Alejandro is saying is, hey guys, you need to do this, you need to do that, because we can't stay in here if we don't see a path for you to pay us. And but it's a case-by-case basis.
It is.
I think James has a really important point. It's to our best interest to make sure that customers, which are almost 100% of our customers, are revolving in nature. So yeah, we're selling to a customer every month, typically on a 180-day basis when you're buying the export finance. And we're only talking about the tip of the supply chain, right? If you really want to think about the whole supply chain of commodity trade flows, particularly in soft commodities, you think of harvests, right? So you're talking about sometimes 360 days, maybe even further, depending on if you want to finance fertilizers. So you can go up to 180 days prior to the crop, putting the seeds in soil, then harvest, then export. And then if you have a poultry producer, do you want to finance all the way their cash conversion cycle? I mean, I have certain shrimp producers in certain markets. You're talking about, 180 days, 190 days typically for their full cash conversion cycles. So if you want to do the whole financing, you need 1+ years of financing for commodity, right? And that's when we start seeing some customers, when you're sending product $10 million every month and you're financing over a year, you need $120 million to finance the purchases of one single customer, right? And let's say, you got a couple, tens of those in the market. Then that's when you start looking at, okay, how many banks do I need to start contacting to make sure that we as a supplier are insured the payment? And yes, we don't necessarily ask for LCs like Emerson does, which is, I think, the safest bet. We underwrite our customers, so we take a part of that risk. And then we ask banks to use factoring or some other mechanism on the trade finance instrument basis to help us support the rest of the trade flows. I mean, we're not in capacity of growing our balance sheet to do the lending to all our buyers. That's impossible. So we basically in the region are working with at least 40 or 50 different banks to support the Latin American markets.
I think we've got time for one final question, if I can. I don't know who wants to answer this, but it seems to me that there's a lot of scope for technology to be an innovator drive here, whether it's blockchain, whether it's other forms of technology too. Can I say a market that's quite old-fashioned in the way that it does business? Is that fair to say? What do you think is going to be the biggest change? Do you think there is really potential for technological innovation here? Who wants to answer that?
It's my turn to throw the ball to Emerson.
Fair enough. Emerson?
Yes, innovation is mandatory in our market. 5 years ago, I was telling them, was totally different than it is nowadays. When we analyze a client, we check his technological capability, okay? If we see that the guy have good controls, Wi-Fi controls, that we can see the crop, everything that is going on in the farm and everything, probably his interest rate will be lower than a guy that do not have any kind of technology applied. Okay, I will give an example. The Terrorlight Group is a Canadian group. They financed a Wi-Fi system in the north of Paraguay. Okay, they invested around 5 million Canadian dollars just to serve soybean producers in Paraguay and the border with Brazil, Mato Grosso and Mato Grosso do Sul. Okay, they are selling these services, and we say to our clients, buy it, because in last instance your interest rate will be lower. Again, we can see what you are doing. Okay, it's not only about technology in the meaning of controlling. In Brazil, what's going on now, they are investing in new seeds. Okay, this is amazing. If you see how seeds are improving and the production are improving, just to give an example, I have a client in the north of Mato Grosso. He was producing, let's say, 100 grains by acre. Now he's producing 123 or 25 in less than 3 years, just changing the seeds. Okay? This is amazing. You increase your production around 20% just applying new technologies. In the near future, in my point of view, a lot of banks or funds or whatever it is, we will have credit lines just to increase technology in the farms. Is what I think. We have a credit line specific to if the client wants to move from GMO to non-GMO. Okay, this is the beginning. But to finance technology nowadays, I just know one bank who financed that. It is a bank based in Holland, ABN AMRO.
There's technology within the industry itself, but then also application of blockchains to bill of lading, that kind of thing. Are we going to see?
Yes, for sure.
Yeah?
For sure.
Well, interestingly, before you get the blockchain, many of the Latin American countries are using electronic filings for tax purposes to monitor fraud. So we said, we're going to make this a new requirement that we want to have your code to get in there and look at that, because we want to see what you're actually reporting. You know, there's the old joke when I first started doing business in Latin America, because I am a gringo, and they said, well, you know, you have 3 books in Latin America. I said, well, what are you talking about? So it's common in the US, you have the financial books and you have the tax books, but I don't know the third books. Well, you have the tax books for the authorities, the financial for your investors, and there's a third set for my wife. I said, oh yeah, I didn't know about that one. But the electronic filings that are now required in many of the Latin American countries are a perfect way to go right in and see what you're really dealing with a company, particularly because we tend to deal with the SMEs. And that's one aspect. The blockchain is still a little further away. I don't know if everyone is familiar with the blockchain, but it's basically a distributed database. And at any one time, anyone on the node, they call them nodes, which is one of the parties that are involved in a shipment, they're going to be able to log on to this distributed electronic database and see where the goods are in the process. Now, when we get there, it's going to be awesome, because you'll be able to follow the product real time, because all the activity of the people participating in this movement of goods are going to be real time updating that agreement. The bill of lading, probably more the letter of credit. That'll be the document that's falling around. It's going to be reduced cost overall, because the estimate is about 25% of the cost of the goods are spent on all these people handling them through the chain. So it will reduce things that take weeks to days, or maybe things that take days to hours. It's going to be a little tough to get it adopted because if you tell somebody we're going to take away the paper bill of lading, there's going to be resistance to that, right? But eventually, and it'll probably come in from the top. There'll be a consortium of banks and the big boys that do it. And then that'll trickle down to the market where it's just like where we say to a customer, we need to see that electronic filing. It's just going to be forced that that's how they get their financing, and they're going to have to use this.
Just to add, I think both Emerson and James had really important points from what we've seen as well. So far, we haven't done our first blockchain transaction in Latin America yet. One of the difficulties has been, as you pointed out, James, is the acceptance of electronic bills of lading by the port authorities at the destination markets. So that's one of the things that the adoption needs to take place to be able to implement all these new technologies in blockchain and in the Wi-Fi tracking and other satellite trackings that are available throughout the supply chain. Focusing mostly on that last final tip of that supply chain from the point of export from a U.S. or a Brazilian port into a destination market where we could easily try to implement some of these blockchain technologies that do exist today is just a matter of adopting the documentation presentation by the destination markets and having those legal authorities in countries like Colombia, for example, accept those electronic bills of lading and FIDOs and other supporting documents that are required for the financing to go through.
Yeah. Well, this time next year, maybe you'll have done your first blockchain transaction.
We hopefully want to. We're definitely tracking what's happening on that industry, and we're keeping close tabs with whoever's really coming up with the latest and greatest. But we don't want to be just watching. We want to be able to say, this is what we need, this is what we want to happen.
Yeah.
Because that will allow us to become a player, an important player in that part.
Yeah. Forward-looking note to end on, and we have overrun. Thank you very much, gentlemen. And please, I think we can now go to lunch.
Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you.